Imagine a company that, bends massive sheets of metal, welds steel in open-air tents, and regularly blows up experimental rockets on the launch pad.
Right, a heavy manufacturing business,
Now,
massive capital expenditures.
exactly. Yet Wall Street is fighting tooth and nail to price it like an asset-light, pure-play software company. Today, we are staring down a $2 trillion math problem.
It is absolute insanity if you look at it through a traditional lens.
It really is. And you brought us an incredible stack of sources to unpack this today. We've got financial media leak reports, private equity research from Sacra, tax planning guides from Augustus Wealth, and even direct pushback from Elon Musk himself.
Yeah, that tweet was quite the catalyst.
Oh, definitely. So our mission for this deep dive is to tear apart what is shaping up to be the largest, most paradigm-shifting initial public offering in human history, which is SpaceX. We are going to separate the retail hype from the financial reality.
Which is exactly what investors need right now. I mean, the market consensus is totally blind here.
Right. We need to figure out how an internet, rocket, and AI conglomerate actually functions on a balance sheet.
And look, the broader market is completely mispricing the underlying mechanics of this business. I mean, analysts are trying to use traditional valuation frameworks, discounted cash flow, standard PE multiples.
On a company that has no peers.
Exactly. It has absolutely no peers. If we want to understand what is actually happening with this IPO, we have to look strictly through an investor's lens. We need to look at the structural leverage, the supply chain vertical integration, and the specific forward triggers driving this valuation.
So let's start with the sheer scale of the liquidity event, because the rumors alone have Wall Street scrambling right now.
Oh, the order books are going to be chaotic.
Absolutely. According to the SEC leaks, on April 1st, 2026, SpaceX confidentially filed their IPO paperwork. They're targeting a listing as early as June.
That is right around the corner.
It is. And they are reportedly looking to float roughly 3.3% to 5% of their total shares. Now, that percentage sounds small until you actually do the math.
The math is staggering.
Right. That float is designed to raise between $40 billion and $75 billion in cash.
Just an unprecedented vacuum of capital.
I mean, just to put that into perspective, the current world record holder is Saudi Aramco. They raised $29.4 billion back in 2019.
Yeah.
SpaceX isn't just trying to edge past that record. They are trying to double it, pulling up to $75 billion out of the public markets in a single offering.
And see, that kind of capital raise fundamentally alters the liquidity of the broader equity markets. I mean, institutional investors will have to liquidate other holdings just to secure their allocation.
They have to make room.
Right. And that brings us to the targeted valuation driving those numbers, which is a staggering $1.75 trillion to $2 trillion.
Which brings us to the contrarian angle here.
Exactly. Here is where we apply some contrarian discipline. The financial media loves that $2 trillion headline. But Musk himself jumped on X just a couple of days ago, on April 3rd, to reply to a Bloomberg report floating that exact figure.
I saw that. It was very blunt.
Characteristically blunt, right. He just said, don't believe everything you read. Bloomberg publishes BS.
A CEO engaging in real-time public price discovery to talk down his own company's reported valuation. I mean, that is unheard of.
Totally unprecedented. But we still have to play with that $2 trillion number to understand the structural disconnect happening on Wall Street.
Let's do that. Because if SpaceX debuts at $2 trillion, they immediately bypass Meta and Tesla.
Right. They just leapfrog them entirely.
Yeah, they would trail only the absolute titans, companies like Apple, Microsoft, NVIDIA, Alphabet, Amazon. But according to the Sacred Equity research in our stack, SpaceX's estimated 2025 revenue was $15.5 billion.
Which is a fraction of what those other titans pull in.
Exactly. If they go public at 1.5 to 2 trillion, they are demanding a price-to-sales ratio of over 100x.
It's astronomical.
I mean, look at Palantir. They're widely considered one of the most expensive software stocks on the market, and they trade around a 79x multiple.
Right.
So how does a company that builds heavy, physical, literally explosive rockets justify a software on steroids multiple?
Well, this is the core insight. The market consensus is treating SpaceX like a hardware manufacturer. But institutional buyers, the smart money, they are valuing them as a monopoly utility provider for low Earth orbit.
Okay, a utility provider.
Right. To understand a 100x multiple, you cannot look at the rockets. The rockets are just the delivery trucks. You have to look at the actual cash cow, which is Starlink.
The internet side of the business.
Exactly. Out of that $15.5 billion in 2025 revenue, Starlink accounted for $10 billion.
Wow. $10 billion.
Yeah, that is 64% of their top line. And the growth curve is just violent. I mean, they went from 10,000 beta users in 2021 to over 10 million active subscribers as of February 2026.
And the performance gap between them and the competition is just widening. The SACA report notes that legacy competitors, like Viasat, they're offering speeds around 20 megabits per second.
Which is practically dial-up compared to what's out there now.
Seriously. Starlink is delivering 215 megabits per second.
The residential market, the people putting dishes on their roofs, that isn't what commands a $2 trillion valuation.
No, absolutely not. The real margin expansion is happening in enterprise.
Let's dig into that enterprise revenue.
So residential average revenue per user, or ARPU, hovers around $2,000 a year. But look at the maritime sector. Putting a terminal on a cruise ship or a commercial freighter commands a $34,000 ARPU.
34 grand per ship.
Right. And aviation is even more lucrative. Retrofitting a commercial airline fleet generates a $300,000 ARPU per plane. That is unbelievable operating leverage.
It is massive. And SpaceX has barely captured 1% of the total addressable market in those high-margin verticals. Once the satellite constellation is in orbit, adding a $300,000 aviation client costs them almost nothing in marginal overhead.
But they can only build that high-margin constellation because they hold an absolute monopoly on the launch economics. I mean, the launch business itself brought in $3.5 billion, mostly driven by the workhorse Falcon 9.
Right, the rockets enable the monopoly.
Exactly. But what stands out in the SACA breakdown is the cost structure.
Right.
SpaceX builds 70% of the Falcon 9 internally.
Vertical integration at its finest.
Yeah, and because they reuse the primary boosters, they have driven the cost of a single launch down to about $62 million.
Which is just a rounding error for legacy aerospace.
Totally. A legacy contractor charges upwards of $400 million for a similar payload. So how does vertically integrating the supply chain actually strip hundreds of millions of dollars out of a single rocket?
Well, traditional aerospace companies operate essentially as final assembly plants. They rely on this sprawling network of thousands of specialized subcontractors, and each one is taking their own profit margin.
So it's just markup on top of markup.
Exactly. SpaceX internalized the manufacturing, but more importantly, they radically changed the engineering philosophy regarding risk and radiation.
Oh, so.
A legacy contractor will spend $100,000 on a single radiation-hardened communication radio just to ensure it survives the harsh environment of space. SpaceX uses a $5,000 commercial off-the-shelf radio.
Wait, how does a standard commercial radio survive orbital radiation and vibration? Doesn't that drastically increase the failure rate?
It does fail. And that is the secret to their economics.
Seriously?
Yeah, instead of spending $100 grand on one indestructible part, they spend $15,000, put three $5,000 commercial parts on the same rocket.
I see.
Right, and then they write software that instantly switches to the backup when the primary gets fried by radiation.
Oh, wow. So they replaced expensive hardware physics with cheap software redundancy.
Exactly. And this creates a self-reinforcing flywheel. Cheaper launches mean they can deploy their own Starlink satellites at a fraction of what competitors pay.
Which means better margins.
Right. More satellites in orbit mean better network density and more enterprise subscription revenue. That massive free cash flow is then pumped directly into R&D to build the next generation of rockets, which drives the launch cost down even further.
Okay, but you are painting this as an impenetrable closed-loop monopoly. Let's play devil's advocate here.
Sure, let's do it.
Amazon has a $10 billion war chest committed to Project Kuiper, which, by the way, they recently rebranded to Leo to push their enterprise readiness.
Right, tying it to AWS.
Exactly. With deep integration into Amazon Web Services, why can't Amazon simply brute force their way into this market and crush Starlink's margins?
Because capital does not buy time in low Earth orbit. That is the contrarian edge most investors are completely missing right now.
Explain that. Why doesn't $10 billion matter?
Amazon has the balance sheet, but they do not have the internal launch capacity. Look, satellites in low Earth orbit experience atmospheric drag. They fall back to Earth and burn up every 5 years.
So it's not a one-and-done deployment.
No, you have to continuously replace it. Starlink already has thousands of satellites in orbit serving 10 million users. Amazon has to pay third-party rocket companies at retail prices to launch their infrastructure.
Oh, wow. I didn't think about that.
Right. SpaceX is launching its own infrastructure at wholesale cost. So every quarter, Amazon delays its deployment, Starlink's network effects compound, and that cost delta just widens.
Okay, so Starlink provides the underlying cash flow. It justifies today's $15.5 billion in revenue.
Yes, the foundational valuation.
But you don't get a $1.75 trillion evaluation just for being a highly efficient internet service provider. Wall Street is buying into something much larger here.
They are pricing in a complete merger of space exploration and artificial intelligence.
Right. This is the catalyst that takes the valuation from plausible to astronomical.
It really is. In February 2026, SpaceX completed an all-stock merger with Elon Musk's AI company, XAI.
That was a massive deal.
Huge. That specific transaction valued SpaceX at $1 trillion and XAI at $250 billion. The sheer capital from this upcoming IPO is designed to fund a mind-bending infrastructure project.
The orbital data centers.
Exactly. Placing up to 1 million AI data center satellites into orbit.
Look, putting data centers in space sounds like pure science fiction to most people. Why go to the immense physical expense of launching servers into orbit when you can just build, massive warehouses in the desert?
Because terrestrial data centers are hitting a hard physical wall. The primary bottleneck for scaling large language models is no longer silicon.
That is it.
It's power generation and thermal management. The Earth's power grids simply cannot handle the gigawatt requirements of next-generation AI training clusters.
The infrastructure just isn't there.
No, it's not. By putting data centers in low Earth orbit, you bypass the terrestrial energy grid entirely. You harvest solar power in near-constant sunlight with zero atmospheric interference, and you use the vacuum of space for passive thermal cooling.
So you solve the two biggest operating expenses of AI electricity and air conditioning.
Exactly. It's a structural cheat code.
And to manufacture the silicon needed for 1 million orbital servers, SpaceX, Tesla, and XAI formed a joint venture with Intel to build a facility called Terafab down in Austin, Texas.
Right. The numbers on Terafab are just wild.
The price tag alone is between $20 and $25 billion. The stated goal of Terafab is to produce 1 terawatt of compute annually.
Which is roughly 50 times the current global output of all AI chips combined. Let that sink in.
50 times. But manufacturing the chips on Earth is only half the problem, right?
Right.
Because if you manufacture a terawatt of compute, you now have thousands of metric tons of heavy server racks.
Yeah, and the Falcon 9 cannot lift that kind of mass at the cadence required.
Right.
You need a delivery mechanism that fundamentally alters the physics of space transport.
Which is exactly why the timeline for Starship V3 is so critical to this IPO. Musk just announced that Starship's integrated flight test 12 is slated to happen in 4 to 6 weeks from early April.
That launch is the make-or-break moment for this whole thesis.
Absolutely. This iteration uses the new Raptor 3 engines and is designed to carry 200 metric tons to low Earth orbit in a single launch.
200 metric tons. I mean, that single rocket can carry more payload than the entire global aerospace industry combined could launch in a year just a decade ago.
So if we pull all these pieces together, we are no longer looking at an aerospace company.
Not at all. The market is pricing in a sovereign closed-loop economy.
Think about the stack. They design the foundational AI models with Grok. They manufacture the physical silicon chips to run those models at the Terafab facility.
Right.
They use Starship to launch those servers into orbit. And then they use the Starlink network to sell the processed compute and connectivity back down to Earth.
They own every single layer of the stack, from the raw silicon to the orbital infrastructure. They are building an orbital AWS.
But because the business model is so entirely unorthodox, the mechanics of how they are bringing this IPO to market are equally unprecedented.
And incredibly dangerous for the stock's initial volatility.
Yes, we have to examine the risk profile, specifically the lockup periods and the retail allocation strategy, because this is where the financial pressure cooker really heats up.
Investors need to pay very close attention to this segment.
Right. So the sources indicate SpaceX is planning to allocate up to 30% of this IPO directly to retail investors.
Which is unheard of.
Completely. The Wall Street norm for a highly anticipated tech debut is usually 5 to 10%. They are even orchestrating a 1,500-person retail investor roadshow in June.
A 30% retail allocation is a massive injection of unpredictable emotional capital. Retail trades on momentum.
Yeah, they do.
But the truly disruptive structural change is the rear that they're scrapping the standard 6-month freeze on insider selling.
The lockup period.
Exactly. Usually, employees and early backers are locked out of selling their shares for 180 days after an IPO to prevent the stock price from crashing.
But SpaceX is potentially allowing early backers to sell gradually from day one.
Yes. And if you are an early employee holding restricted equity in a private company right now, your ears should be burning.
Oh, for sure. The Augustus Wealth Planning Guide goes deep into the tax nightmare these employees are currently living through.
It's brutal.
This IPO isn't just a chance for them to buy a yacht. For many of these engineers, it is a desperate financial rescue mission to pay the IRS.
Let's talk about the restricted stock units, or RSUs, because the structure at SpaceX is what we call single trigger.
Break that down for us. What does single trigger mean versus a standard?
So in most private companies, RSUs are double trigger, meaning you don't actually own the shares and therefore you don't owe taxes on them until a liquidity event like an IPO happens. But at SpaceX, the single trigger means the shares vest purely based on time, typically every May and November. And that happens regardless of whether the company is public or private.
So every 6 months, an engineer has shares vest. And the IRS views that vesting as ordinary income.
Exactly. Income that you have to pay taxes on.
So if the internal private valuation of the company skyrockets, that engineer suddenly owes income tax on hundreds of thousands of dollars of stock.
Yep.
But because the company is private, they cannot sell a single share to generate the cash needed to pay the tax bill.
Right. The withholding gap can easily reach 6 figures. They are wealthy on paper, but completely illiquid in reality.
And that is just the RSU trap. The incentive stock options, the ISOs, create an even more volatile mechanism known as the alternative minimum tax.
The AMT is going to blindside a lot of these engineers.
Let's walk through exactly how the AMT traps these employees step by step, because it perfectly illustrates the pressure leading up to this IPO.
Okay, imagine an early employee who is granted ISOs with a strike price of $20.
Okay, $20.
They want to exercise those options while the company is still private to start the 1-year holding period for favorable long-term capital gains tax rates.
That makes sense.
It does. But the pre-IPO valuation has pushed the fair market value of that share to $500.
So they pay $20 to buy a share worth $500. They have $480 of profit on paper.
Exactly. But they haven't sold the share, so they haven't made any actual money.
Right.
However, the IRS forces them to calculate their taxes under the alternative minimum tax system, which taxes that $480 phantom spread as if it were real liquid income.
Phantom income. That is insane.
It gets worse. If they exercise 10,000 shares, they suddenly owe the IRS hundreds of thousands of dollars in taxes on money they do not have in their bank account.
Wow.
If they don't have the liquid cash to cover that AMT bill, exercising the options could literally bankrupt them.
So these employees are essentially forced to wait for the IPO to generate the liquidity needed just to survive their tax liability.
Yes, they are forced sellers.
But if you open the market with a 30% retail allocation, retail investors who are enthusiastically buying into the sci-fi dream of orbital AI data centers, and you simultaneously remove the insider lockup period, allowing thousands of tax-strapped employees to aggressively sell their shares on day one.
It's a powder keg.
Aren't you engineering extreme, unprecedented volatility? Are we looking at a multi-trillion-dollar meme stock where the initial price action is completely divorced from the $15.5 billion in actual revenue?
That is the structural risk. You have inelastic demand from retail investors colliding with inelastic, forced selling from employees who must cover immediate, massive tax liabilities.
The mechanics of the order book on the morning of that IPO will be completely detached from the fundamental valuation of Starlink or the Falcon 9.
Totally detached. And if you remember one thing from this deep dive, it is this: the market is struggling to price SpaceX because it is trying to value a combination of heavy industry, global telecommunications, and AI infrastructure through a single equity ticker.
Which has never been done before.
Right. The fundamental cash flows of Starlink are incredibly strong, but the execution risk of Terafab and Starship V3 scaling to meet this $2 trillion expectation is immense.
We have covered a massive amount of ground today. We analyzed a company built on a foundation of reusable rockets that dismantled legacy supply chains through software redundancy.
The cheap radios.
Right. We looked at how that launch monopoly bankrolled a global satellite internet network, which is now generating the free cash flow to fund a future of orbital AI data centers.
The orbital AWS.
And we broke down how all of these catalysts are colliding in an unorthodox IPO structure that could trigger historic market volatility.
It is going to be the most watched trading day in modern history.
To you listening, thank you for bringing this incredibly dense, complex stack of sources to the table. It highlights exactly how modern capital markets are stretching and breaking to accommodate unprecedented technological ambition.
It really redefines what a tech company can be.
But I want to leave you with one final thought to mull over. If SpaceX successfully executes this master plan, if they manufacture the Intel chips on Earth, launch the servers on Starship, manage the data in orbit, and sell the compute back to the surface via Starlink, does it actually cease to be a company in the traditional sense?
That is the ultimate question.
When a single closed-loop corporate balance sheet controls global internet access, space transport, and orbital computing infrastructure, are we witnessing the birth of a new kind of sovereign entity? Something to think about the next time you look up at the night sky.